In this video, we are going to do a master class on how to calculate leverage for gold miners. And I have received a lot of questions about how I calculate leverage. I don't think a lot of people really understand how this is done. They think that a low margin company will have high leverage. That's absolutely not true. There are a lot of parameters involved in calculating leverage for gold miners. So let's start with this. Okay, so leverage in the gold mining space is calculated from after-tax free cash flow. That's the first thing. You can also use net earnings, of course, but I like to use the free cash flow because that also involves the capex. So how do you calculate free cash flow? Well, there is a formula for that based on production, interest expense, taxes, all-in sustaining cost, capex, and of course in the gold price. But that's for another video. So just take the free cash flow after tax. That's the first parameter. Second parameter is the market capitalization. Do not use the enterprise value because leverage comes from the market cap. If a company goes up in value due to it having higher free cash flow, then the share price goes up. Okay, the share price goes up, and that means the market cap goes up. It's not the enterprise value that goes up, because here you also have the debt. And it's not the debt that goes up, it's always the share price that goes up. So you need to use the market capitalization. And the third parameter for calculating leverage is the multiple. Very important. If you have a very large company, they have higher multiples, like a PE of 10. And a PE of 10 has higher leverage. If you take a small company, like Soma Gold, which we will talk about today, then the multiple is lower. Multiple of 4 or 5, that's what I use. So multiple is very important. It also depends on the mine life. If you have a very high mine life, probably the multiple will be higher and there will be more leverage. So 3 important parameters. Okay. Now, this is the formula. Leverage is defined by the multiple, in this case 5, times the free cash flow 2 minus multiple times free cash flow 1. And then you divide it by the market cap. It's really that easy. And free cash flow 2 is the free cash flow at double the current gold price. So this here. And free cash flow 1 is the free cash flow at the current gold price, 2000. So that's this times the multiple, of course, 5 times. So what you do is you take 550, for example, minus 150, and that's 400, right? This minus this is 400. And then you just divide it by the market cap, which is this number here. That's about 60. So 400 divided by 60 is a 7x leverage. That's the leverage, 7x. So if gold goes up 10%, then this company, Soma Gold, will go up 70% because it has 7 times leverage. Let's do another thing. We go from 2000 to 2200. That's 10% increase, right? 10% increase. So you go from this valuation, 5 times net earnings, to this valuation. And that's an upside of around 50 million from here to here. Okay. and the market cap is 60 million. So if you go up 10% in gold, then the market cap should go up like this, go up 50 million. So from 60 to 110, so that's 70%. So 10% up in gold means 70% upside in the market cap of Soma Gold. Understand how 7x leverage comes from this formula. If you don't understand, just keep watching this video. Now let's go to the example of Soma Gold, a real life example. And here are the formulas. We have the free cash flows here, using all of these production numbers, capex, etc., all-in sustaining cost, interest, and tax. And here we have the leverage formula, using the gold price and all of these parameters. So now we can actually do a sensitivity analysis. And the first thing that I want to change, just let's go from the beginning to the end. Production. Production is extremely important for leverage. If production of Soma Gold doubles, and look at this number, 7 leverage. If this doubles to 90,000, what happens to the leverage? The leverage doubles to 13. So in order to grow a company and its market cap, we need production. If production goes up, then you will get more leverage to the gold price. That's very good for any company. You want production to go up. Second, capex. Is capex going to influence leverage? Let's say we go to 0. Nothing happens on the leverage with capex. 20, it doesn't change leverage. It only changes the EV to free cash flow. So capex doesn't have any effect on leverage. Let's take all-in sustaining costs. Do you think that the all-in sustaining cost affects leverage? Many people say yes, because they think a higher cost mine has lower margins, so the leverage should be much higher, right? Well, wrong. If I go from a 1000 AISC to 1500, nothing happens to the leverage. It's still 7. Okay? So all-in sustaining cost has no effect on the leverage of a company. Absolutely no effect. What typically does happen if the all-in sustaining cost go up, then the market cap goes down. And we'll see that the market cap does have an effect on leverage, but not the all-in sustaining cost. Interest is the same as capex. If it goes to 0, then nothing happens. The next one is tax rate. So tax rate is also a parameter. Let's say we increase the taxes to 50%. Then you can see that leverage goes down. It was 7 and now it's 5. So tax rate has an effect on leverage. So watch out for this one. And the last parameter is hidden somewhere here, the market cap. So let's say we increase the market cap. Okay, so it's this one. Market cap increased. Let's say Soma Gold shoots up tomorrow, doubles in price, because I expect it to double in price to 120 market cap. Look, the leverage goes down. It goes from 7 to 3.5. So that's the leverage is cut in half because the market cap went up double. So yeah, market cap does influence leverage. Now, I have a comment on previously on the all-in sustaining cost. Typically, when the cost goes up, right, nothing happens on the leverage. But of course, if a company suddenly has much higher costs, then yeah, the EV to free cash flow goes up. So that company becomes overvalued, and then the market cap will probably drop, maybe to 40, to go back to a lower EV to free cash flow. And then you can see that the leverage increases to 10. So this is how people think that margin will affect the leverage, but that's actually coming from the market cap, okay? It's because the market cap drops first and then you have higher leverage. But it doesn't come directly from the all-in sustaining cost. Okay? Do you understand? If you don't understand it, just watch the video again. To summarize, leverage changes with production. Higher production gives more leverage. Market cap, if market cap goes up, the leverage goes down. So take that into account. If you have a company and it goes up, your leverage is going to go down. So please find another company. If something goes up, for example, we have a very good example here. Mako Mining was a company that I really liked, but they doubled in price. Okay, they doubled in price. It was somewhere here at 3 EV to free cash flow. Leverage was pretty good at 4. Now it has doubled in price, so the leverage has now cut in half. It has been cut in half, so leverage is not that good anymore. It's only 2 leverage. So I switched this over to Soma Gold because here we still have 7 times leverage to gold. So very important to understand this mechanism of market cap because this changes the leverage. Production will go up at Soma Gold, so leverage will increase. Gold price, also important. If the gold price goes up, let's illustrate this. So look at this orange line. I'm going to put this a bit higher so we can look at it. So here's the gold price. If the gold price goes to 2,500, then this whole orange line shifts upwards. If it goes 3,000 gold, then it goes up even more. So Soma Gold had 7 times leverage and now it's 10 times leverage. Why? It's very simple. Because if you start from a higher gold price, then an incremental percentage growth in the gold price will of course have higher incremental growth in the value of the company, okay? Because you start with a higher number. So that's gold price. A higher gold price will give higher leverage to a company. Tax rate, we already know that. The higher you get taxed, you will get less leverage. So watch out. Normally the tax rate won't change, but some countries, they will increase taxes, like in Chile. And of course, the multiple, also important. Bigger companies have higher multiples. So what you will see is this is 5 times net earnings. So this is the slope. But if you do 10 times net earnings for bigger companies, then this slope will actually go steeper, right? Because you have a certain free cash flow and you do 5 times this. If you do 10 times this, then this is going to double here. But here, this one will double even more. So you get a steeper slope and more leverage, of course. So that is the multiple, very important. You need to look at the size of the company. Yep. Bigger size means more leverage. Leverage does not change from all-in sustaining costs. So if someone tells you that a high cost mine is going to have more leverage, he's completely wrong. Leverage does not come from high costs. It comes from actually the market cap. Capex also does not change the leverage. We have seen that in our tutorial. And interest also does not change that. It's the same as Capex. So that was the small masterclass about calculating leverage for gold miners. I hope you learned something. Bye.